The common practice when trustees hire fund managers, external fund managers, is to give them a benchmark against which to manage the portfolio. And the benchmark is typically a market cap index. It can be also a peer group performance index. And it's been common practice now for three or more decades. It's a good way of restricting the scope of asset managers. One, in case they happen to be no good and therefore do poorly, or if they take too much risk. So benchmarking is a very handy way of dealing with the problem of delegation, of delegating to somebody external to the fund. And that is the way the bulk of assets are managed. Maybe 95% of assets are managed to a market cap benchmark. And even if there's no explicit benchmark given by the trustees, managers still like to stay close to their peers in terms of performance and stay close to what they perceive as the index benchmark. And that has gone on merrily. It's what is completely standard practice. The trouble is that there is a serious ugly feedback effect of benchmarking, which has never really been addressed or properly understood. And the reason that happens is that when the fund manager is managing the assets, he can't stray too much from the benchmark weights. And if high-risk stocks start to shoot ahead for whatever reason, he has to chase those stocks. The supreme example was the tech bubble, where tech stocks went through the roof. And even if you thought they were ridiculously overvalued as a fund manager, you had to buy them to keep in touch with the benchmark. And the effect of that across all managers and all funds, because it's going on all the time across all managers and funds, the effect is that the price of high-risk assets gets pushed up and their returns pushed down. And the result is that high-risk securities, whether it's equities or bonds, but particularly equities, high-risk equities deliver a lower return over time than low-risk stocks. So in fact, one of the principal asset pricing theory, the CAPM, which says the higher the risk, the higher the return, is actually not true. It's known not to be true by empirical studies as way back as far as the 70s, and the studies are more comprehensive subsequently, and they continue to show that over time, obviously in any one year it can be, they can behave conventionally, but over time, over a run of 3, 4, 5 years or more, high-risk stocks deliver something like half the return in global markets than low risk, which is an extraordinary, it's Alice in Wonderland. The world is upside down. And and this has not been understood by economists why this, or practitioners, why this occurs. But my work at the London School of Economics with colleagues, we have formalized the understanding of that by showing that it is actually a benchmarking which is causing the inversion of risk and return. And so what that means is that, one, fund managers are being forced by their contracts with the trustees, they're being forced to buy more high-risk, low-return securities than they would if they had the freedom to invest without the constraint of a benchmark. And secondly, it means capital in the markets, global markets, gets misallocated. It gets misallocated. More gets allocated to high-risk securities and high-risk companies and high-risk ventures, and indeed short-term, because it is a short-term phenomenon. In fact, benchmarking is the classic feature of short-termism.